Hello, everyone, and welcome to another episode of the Reinsurance Podcast. I'm your co-host, Jerad Lee.
And I'm the other co-host, Ben Rose.
I got my name spot on that time, right out of the gates.
I know. You could say you've had some practice by now.
Yeah. We wanted to do this episode. I was at an event in London a few weeks ago, and another sort of startup founder, inspiring founder, was talking to me at the end of the event, and was one asking about sort of the funding process and how it works for a startup. And I thought it'd make for an interesting conversation for us to have on the podcast, not only from a how do people think about it as they think about challenges they face in their business, they get ideas they want to pursue. And I like it a lot as this thing we build towards is the sort of building a technology company part of our podcast. But the question that she sort of brought was how to think about whether you bootstrap, i.e., don't raise any money from outside sources and try to build a little bit of a product by which you then sell and you grow without any outside investment, or you raise investment from various means, including venture capital, the route that we've chosen to take. So I thought I wanted to kick off this podcast with that as kind of the angle of evaluating those couple components.
And I've got a bit of a hit list for you as we go through. Can we try and demystify and explain to people all these strange terms? You've already done Bootstrap, so that's a strong start, but all the sort of alphabet soup of Series A, B, C, and what all that means, it'd be great to talk about maybe some of the terms like seed and early stage, late stage, and down rounds. There's really an up round, but all this sort of thing I think would be quite interesting.
I did see a news article with someone who'd raised an up round. I was like, ooh, just a regular round, do you mean? Unless it's a down round? So it was
an entirely neutral round.
Yeah, we'll do a number of episodes, I think, across this, because I think it's an interesting space. But when you think about the two major options you have is bootstrapping, which is, again, as I mentioned, not raising any money at all, or pursuing what's called venture capital. And what these firms often do is they look for ideas and teams and products by which they can inject some capital into for a sort of stake in that organization as they grow.
And I think it's worth clarifying as well that in this conversation we are talking specifically about the type of new company that's generally referred to as a startup.
Yeah.
Because, and by that we mean a hopefully fast growing and ultimately very valuable company, and not you opened a hairdresser's or a new
not a small business
or a local convenience store or a franchise. Because in order to qualify effectively for venture capital funding, which I think we're using as a big umbrella term to include also angel funding and other things, but this 1 in 50 opportunities comes off and makes you a millionaire type investing. You have to be able to point to a roadmap that takes your planned company eventually to becoming a very titanic, kind of enormously successful company.
Well, and that was sort of the direction I took the conversation with this woman at this event was bootstrapping is a great idea if you believe that the product that you have has sort of a finite sort of opportunity size to it. Like if as you use some examples of pubs or hairdressers or similar, if you're looking at it where the best case scenario is this company makes a couple $1 million a year or a few $100,000 a year, and that's a really good business, bootstrapping is an amazing way to do that. But it doesn't allow you to sort of pursue a much larger business. Again, there are exceptions to this. There's a few companies, MailChimp being kind of maybe one of the more recognizable, that bootstrapped for much of its journey, that ended up being an enormous business. But that's not very common. So it was an assessment of, one, how do you want to build your solution? Is your ambition, and I think ambition ties into this as well, is your ambition to have it where this company pays for your family's needs and you're happy with that? Or is the ambition to build a industry defining company, something that has a huge impact on a global scale? And venture looks for ideas that have that potential at some stage. So it's a real assessment as to what you're trying to build, and then calibrate what you want to do from there. Not to say there's one is better than the other. I've no position on when we've chosen the path that we chose, but
No, absolutely, and I think it causes a lot of interesting side effects in terms of I if you're bootstrapping, etc., and you're going down a route which is maybe less industry defining in what you're trying to create and more just a successful company,
Mhm.
I then that can be a really reasonable approach. The venture capital angle brings with it a lot of the time I an ability to tackle the unknown or the new or the reimagining of an existing process or industry or behavior or whatever it might be.
Yeah.
And with that comes the promise a lot of the time that somebody else is going to do it if you don't.
Mhm.
And so you not only need more capital than usual to get going, but at various points in your life cycle as a business, you need capital to build defensive moats to be able to aggressively scale something known as blitz scaling
Yeah.
so that you can accelerate away from potential competition at a fast enough rate to protect this industry defining thing that you're
Yeah.
building. So a lot of the time, if you're going down the bootstrapping route, if a startup down the road says that's a brilliant idea and then raises millions to go and do the same thing, they're probably going to quickly outpace you and steal
Yeah.
the market you're going after. So
Yeah.
another reason a lot of people would go down the venture capital route
Yeah.
instead.
Yeah. And again, that idea of what the business can be or what you want it to be is impactful there, right? Like if you wanted to bootstrap or take a small loan out to start a restaurant, there's not a bunch of people who are going to try to out restaurant you. Like there's going to be the local restaurants who compete against you, but there's not this sort of pursuit of redefining the dining experience or something in
Yeah.
a but when you mentioned earlier in the sort of word soup kind of piece, you have a number of different things. One of the elements is what's called stages. Like where are you at as a business? And you have sort of the pre-seed, seed, and sometimes A is considered early stage businesses. And from there, it's companies taking a bigger bet on you. The value of the company is smaller because you've not proven yourself to be worth as much yet. So the investment people make is disproportionately large for the check size that they write. But you're essentially taking what is an idea or some founders or some early product traction and trying to see, can this business go to this next stage? Get the first few clients, get the first few million in revenue. Is it something that actually has legs? And the investors who invest in that category are looking at the the various sectors that they're in, the team, the idea, the market conditions, and trying to evaluate, does this team and this product have a chance to do something really special? Again, you alluded to it, they miss a lot, right? The most of the time they say yes and they back a company and that doesn't actually work. Once you get into the growth stage, usually Series B and beyond, is they've proven a number of those sort of traction points. Now they're saying, we've done this over and over. And now what we're going to do is we're going to raise a huge amount of money and go into Europe or go into North America or go into Asia. And we're going to expand into 4 more products. And it's this sort of real land grab scale stage where you're trying to, as you said, grow faster than anyone who could catch you. So there's a few different phases that those businesses go through, and the journey that they pursue in pursuit of that predefined huge business objective.
And it's maybe useful for people to understand, I guess, then what happens at the end of all this in terms of a potential exit
Mm-hmm.
as well, because you have a few options available, but also to understand all along this journey what happens to the ownership of the company, because as you mentioned, the stake that you get as an investor isn't predefined in terms of how much money you pay. It's often how much risk you're perceived to be taking based on the stage and proof points that company has. So, if you spent £1 of investment in Series A, that £1 of investment in Series C would get you a lot less of the
Yeah.
company. And similar, but could you maybe explain a little bit about how dilution works
Mm-hmm.
and so I think one interesting facet is that you don't actually give away your existing shares, but you create more
Yeah.
and this sort of thing.
Yeah, yeah. There's some really interesting articles about this, but there was one that talked about, weirdly, if you want to get rich, bootstrapping is your best chance at it because you always own everything. So if you bootstrap your business and you sell it for 4 million, like you get 4 million, like that's all
Yeah.
yours. But if you start raising venture, you introduce this concept of dilution, which, as you said, is more of, you're not giving away part of your share, you're just adding more shares to the pot. But as the business grows, each round you raise of investment dilutes the company, introduces more shares each time. So the ownership dilutes every round that you raise. So if you are a business that raises 4 or 5, 6 rounds of investment, which many of the really large companies have done, they have to become really, really large for those sort of core team members to get that reward. Which again happens a lot, and there's a lot of really successful exit scenarios that reward those early colleagues and those sort of founding team members and things. But it's not a guaranteed path, and and so when you're evaluating what you want to do, I think in all scenarios it should be is this a thing you want to do forever if it comes to it? Because in both scenarios, there's not really a like get out of jail card. If you decide I don't really feel like doing this anymore, you've got people and you've got clients and these things that happen along the way that you can't just walk away. Like you've tied into this, so you better do something you like doing regardless.
Mm.
And then in the best case scenario, it's going to be a thing you spend a decade working on. So you should really care about what you want to do. Um, but then as you raise each round, it's how do you continue to achieve the targets that the business has to sort of grow through those various stages.
Yeah. The bar lifts every time, right?
The bar lifts every time. And then when you think about what exiting looks like, an exit is where those investors sort of realize the gains. Again, much of investment in early stage companies, the gains there are made on paper. You invested in a company that was worth 2 million, and now they just raised a new big round of funding, and they're worth 100 million. Unless they've created a scenario by which you can sell your shares, which a lot of times they haven't, that doesn't mean anything. Your shares are worth a lot on paper now, but you need this what's called an exit event by which you can sell some of those shares that you have now. It looks a few ways. It can be an acquisition, probably one of the most common ones. Another company or someone in the space, potentially even PE, says they want to buy that company, and you can sort of realize gains that way. IPO is another one where if you get sufficiently large, going public as an organization presents an opportunity to reward those investors early on. But there's this sort of scenario where the business is big but sustainable, and there's no real exit scenario. In which case, I think CB Insights calls them zombies, which is a bit harsh.
Depends how they're doing, I think.
Yeah,
There's
yeah,
ones in the
exactly.
land of the living dead, but I mean, you also can have some that pay very happy dividends.
Yeah, but you could, if you're successful enough, you could introduce a dividend model or similar, which I think. But those are the sort of the three primary options for sort of the complete exits. But it's a really nuanced and fascinating space.
Yeah, and I wanted to add a bit more context to how these companies also get valued. We talked a little bit about how the on-paper valuation, is kind of meaningless until you exit, but the way those valuations are constructed is fascinating. So typically, they use something called comparables, to try and figure out at the end of your journey as a startup, how valuable are you going to be in that exit scenario? And they'll look to, okay, well, what has a similar by the end of your journey, fintech or health tech or whatever thing you might be. We're focusing a bit on tech companies here because they tend to be the main sort of source of startups at the moment. I could be making e-scooters or whatever, and in which case they might look at how much a auto manufacturer is worth, as a comparable, and say, okay, well, great, if they make it, they will be worth this much money, and then my bet is how likely is it that they will make it to be worth this giant pile of money when they eventually IPO or exit. And what's been very interesting to observe, and has been commented a lot on in the last year or so, is that because a lot of big tech firms have had a big fall in their value, as we've had this lagging impact to the stock markets from the war in Ukraine, from the post-pandemic sort of impacts just starting to be felt. That's actually then had impacts on startup valuations all over the chain as well, because you're no longer projected to be as valuable as Facebook at Facebook's sort of peak in 2021, but you're now projected to be at whatever it is in 2022,
Yeah.
and so on. So that goes up and down all the time in a way. So it's a very fast-moving market with the VCs
Mm.
constantly trying to adjust their comps. I was listening to a really interesting talk that somebody at Seed Camp, or somebody visited Seed Camp to give recently, talking about how the fintech comps, especially at the moment, are all over the place because you can sort of cut the fintech startup market by those that are exposed to the financial market conditions of changing interest rates and inflation, etc., whose models depend on those having stayed low and inactive for a long time, and those that are actually completely unaffected by that, and those that work with consumers who have changing amounts of disposable income available to them and different attitudes towards saving or not saving, and those that maybe work in B2B and are helping firms find efficiency savings.
Yeah.
And so a lot of the time, finding the right comp to be able to base your valuation on can be really tough. And it's hard to make a generic statement like fintech's hot, fintech's down, or that sort of thing, because there's so much different exposure to take into account.
Yeah, and you'll see as well sometimes the comps to other startups as well. There's this behavior that follows people sort of rush into categories, and we talked about in the scale journey, building moats and sort of making sure that you don't get outscaled by peers of yours or similar competitors of yours, which sees a rush into categories. Think about like food delivery, like the number of companies that rushed into that space and the funding that was being thrown at that, even though the model was never really proven to be really successful. Um, but this sort of rush to deploy billions of dollars in investment into those organizations because everyone is sort of doing that was hot. And then as those firms go public and really struggle, like everyone kind of turns away from that really quickly. I think fintech has seen similar things where there's a huge focus for a while on improving access to debt, short-term debt, all these sort of little instruments which are really helpful. And then you see struggles by like a Klarna that valuation came crashing down. Everyone sort of froze on that whole space, and what they believe to be true now maybe isn't, and so there's a bit of a panic
Yeah.
buying there.
Especially, I mean, if your investment thesis for a lot of these firms is like,
Mhm.
you're going to be the next Yahoo,
Yeah.
or Yahoo, do you call it in the US?
Oh yeah, very nasally A. Like a
um,
cowboy A.
yeah, but,
Yahoo.
that's at some point that must have been like a cataclysmic. Oh, okay, no, the market doesn't want Yahoos anymore.
Yeah.
So yeah, constantly recalibrating, and that's where you end up with what we sort of mentioned at the beginning of the episode, things like down rounds,
Yeah.
where basically, rather than what you typically expect to happen, which is that at each funding round, when your value is reassessed by the set of participating investors, rather than it being like, yes, we're going to give you this new investment on the basis that your valuation has increased to X or Y, which is what normally happens.
Mhm.
Actually, they say, you need this new investment. We still think you've got a future, but your previous round, those previous investors got their calibration off.
Yeah.
And therefore, you're going to have a down round. And so we've seen
Yeah.
quite a lot of firms recently having to have down rounds
Yeah.
because of the mystical 2021 where
Yeah.
everyone
I mean,
was peaking in valuation.
investment was cheap and people took really high valuations that early stage investment as always sort of has reaching multiples and things, and that's very common, but they were beginning to be like very extreme, and when the conditions shifted, there's a recalibration there and went, yeah, we're not going to give you like 300 times your revenue as your valuation anymore. And even though it took a bunch of money at the time on that, they're sort of left scrambling to figure out how they keep the business going. And yeah, so they raise again, but at a lower valuation than they did the last time, which is called a down round. Yeah, which is not. I wouldn't have any projections as to how common or uncommon that is, but it's certainly not desirable as a business. You want to continue to grow, and you're saying, with this new money, we're going to hit these milestones, and you do, and you're like, look, and then they go, you're doing great, and they give you a greater valuation. This is sort of the process by which you follow.
And it's interesting. I think another thing I've got to mention this buzzword, unicorn status.
Yeah.
When your revenue, when your valuation exceeds $1 billion. Have I done that right?
$1 billion private company value. Yeah.
I basically, this has been interesting recently because similar to actually IPO statistics as well, we've seen the number of unicorns actually has massively dropped as in new unicorns in the last year, just because of the depression on valuations. So I think and don't quote me on these figures, but if you look at the issue The Economist published in mid-October, they referenced it in there as being something like 2 new fintech unicorns in 2022 so far, or something, versus 23 in 2021.
Yeah.
And then similarly, IPOs was a similar story. I think they'd had about 7 IPOs, or less, like this year versus or in the last quarter versus a comparable end of 2021 quarter. So currently in a bit of a dip, but this is what always happens. So everyone's sort of just waiting to see which way up it goes and when.
I mean, good businesses will always find funding. I think there was an era where, kind of like the dot-com bust, where the excitement was so great that people were throwing money at everything, and now they're taking a recalibration to say, what are the good businesses? What are things we like? What are the models that we think will work over time? And those businesses will always have opportunities available to them. So it's still a thriving space. Again, we'll touch on this in loads more episodes about building technology companies and venture and everything else. But I wanted to address this one following some interesting conversations in the insurtech ecosystem in London.
Indeed. And if you haven't been to the Lloyd's Lab to meet the newest set of startups and Supercede's sort of working HQ, come on down and see us and meet all these exciting new startups changing the insurance and reinsurance industries.
Perfect. We'll either see you there or see you here on the next Reinsurance Podcast.